Hello, everyone, and welcome to the second quarter 2023 iSectors Market Review. I am your host, John Koch, Senior Investment Analyst at iSectors, and today I'm joined by the CEO and CIO of iSectors, Vern Sumnicht. How are you doing today, Vern?
I'm great, John. Thank you.
Good, that's good to hear. In this video, we will walk through a brief outlook on our current views of the market and the economy. We will also briefly touch on second quarter performance of the iSectors models, along with a quick rundown of some changes that were made last quarter in the couple select models. As a reminder, if there's anything we don't touch on today, you can always view our full performance data for all our models on our website, iSectors.com, or reach out to us with any questions or concerns you may have after you view the video. So, without further ado, let's get things started by discussing what our research is currently telling us about where markets are headed going into the second half of 2023. Take it away, Vern.
Thanks, John. We have some interesting things to talk about, I think. The models, especially our post-MPT models, research is showing us that things are still conservative. We're still cautious. We see some problems with the yield curve yet. The yield curve is inverted, stubbornly so. We're seeing fiscal policy that's expansive with unprecedented 1.5 trillion in annual deficit spending. We're seeing government debt levels that have grown to 32.5 trillion. And interest expense now is grown on government debt. It's nearly 1 trillion annually. This in contrast to the Federal Reserve's trying to restrict monetary policy with higher interest rates. We think there's kind of a conflict going on here in that this may be a pause by the Federal Reserve on interest rate increases if the fiscal situation doesn't change. But it leads us right now to stay in a fairly stagflationary mode with our investment models. On the other hand, there is some good news that's beginning to show, and that's the unemployment's been stable. Inflation's been down a bit, still running at 4%, but that's better than the 7%-ish that it was running at for a while. So that's good news. We're also seeing the breadth of the market improve. The stock market's been improving, the S&P and the NASDAQ index especially. However, it's been powered really by 10 stocks, 10 large cap tech stocks. And that's been going on since October. So no one's been getting too excited about the S&P and NASDAQ going higher. However, recently, the breadth of the market is improving. And we're starting to see the other indexes follow along. Even the transportations recently have moved in the right direction, and we're seeing many more stocks participating, going higher, other than just those large tech stocks. And that's very good news. The market looks out 6 to 9 months. So the market may be telling us that it's going to see a change in those other factors, right? The market's telling us that some of these other negative factors may improve in the near future. To that point, we're noticing that as we're allocating our post-MPT models, it is an objective approach. So it's a very quantitative approach, but that quantitative approach, looking at the factors and the changes in those factors, has been leading us to increasing allocation to technology in both models. So we've seen that start in the second quarter, but currently we are up to about 30% allocation in technology in our post-MPT growth model, and a 20% allocation to technology in our post-MPT moderate model. We still have gold in both of those models, and we have some long-term government bonds in both of those models. So they're still fairly conservatively allocated, but we certainly are noticing a change and looking at some of these growth indicators that we're seeing in the market. Hopefully those will continue. any rate, John, you want to give us a little more detail?
Yes, I do. Thank you, Vern. That was good. So I'm going to speak on, Vern spoke on our post-MPT models. I'll touch on those as well, but I want to hit on the rest of our models that we offer in our suite. We have models available for almost any of the scenarios that Vern mentioned before. If inflation does kind of reverse and stay high and sticky, we have two inflationary models, the iSectors inflation protection allocation and the iSectors precious metals allocation. Now, so far this year, they've underperformed their benchmarks and the broad markets, but that's because of the cooling inflation that we've seen so far that Vern pointed out. In 2022, when we had that hot inflation running, they did their job. They were two of the best performing iSectors models during 2022. So we have the inflation bucket covered. We also have the restrictive Fed policy covered as well, if interest rates remain high, in the form of the iSectors capital preservation allocation and the iSectors domestic fixed income allocation. These two models are both short-term bond portfolios in nature, with the capital preservation being a little bit shorter than the domestic fixed income allocation. You can see here they both have outperformed their benchmarks so far in the second quarter and over the last year. They also did so in 2022 as well. The iSectors capital preservation allocations benchmark is a 1 to 3 year government bond index, and the benchmark for the iSectors domestic fixed income allocation is the Bloomberg aggregate bond index. So both models are shorter in duration than those two indexes, and that's really helped them outperform this year and last year with this high interest rate environment that we've been living in. As Vern mentioned, we also have our post-MPT allocations, which even with the technology position that they've added, do remain hedged for almost any scenario that's on the screen here, but they are downside focused in nature. They will always focus on downside protection over everything. And that you can see that here where they haven't participated in as much of the upside so far this year, both in the quarter and over the last year. In 2022, however, they both achieved their objectives, and they were about 50% down of what their benchmarks were last year. And so depending on how situations improve going forward, they have that tech exposure to hopefully participate if this run continues, but then they're also hedged for inflation and a potential recession as well. And we also have a model that if that tech run does continue and the market continues to improve across the board, we have our risk on sort of model with the iSectors crypto block allocation. As you can see here, returns were strong both in the second quarter and over the last year, beating its blockchain technology benchmark and the broad S&P 500 as well, which is the benchmark for the post-MPT moderate here, up 19.5 the last year, whereas crypto block was up 29% over the last year, net of fees. So if you want something for a risk-on environment, the iSectors crypto block allocation will fit your needs there. Speaking of the iSectors crypto block allocation, I'm going to speak just a little bit more on this model because it is one of the models that we made changes to last quarter. We added a couple of diversifying blockchain equity ETF positions to this model. Previously, we only had 6 ETFs in this strategy, and while we think that we're properly diversified there, given the choices that were available in the blockchain equity ETF environment, there's things transformational data sharing, crypto innovators, and like transformative processes and things like that within this the marketplace. The offerings there have really expanded since we first launched this model 2 or 3 years ago. So we added a couple names there to bump the total ETF holdings of the model from 6 up to 8. And even with that, though, we kept, as you can see, the target weight here, we kept our target weight at 50% Bitcoin futures ETF, which it tracks the returns of Bitcoin very well, as we'll talk about in a moment in the chart below. But we also have the other half of the model allocated to blockchain equity ETF. And that includes things that I mentioned before. And we added a fintech ETF, a metaverse ETF. So we're really trying to broaden out that other half of the portfolio that is not invested into Bitcoin futures to provide some diversification within this space there. Now, that leads me to the chart below. Just speaking about Bitcoin and the crypto block model in general, this chart shows the daily returns on a 30-day rolling basis the correlation of the returns between BITO, which is the ProShares Bitcoin Futures ETF, and the SPDR S&P 500 ETF SPY. As you can see, throughout 2022, here's the first half of the chart, the correlations between these two asset classes were very high, as everything in 2022 struggled. So the correlation of everything last year sort of increased, whether that was bonds or Bitcoin or equities. But as we go through 2023 here, we can see the trend is moving downward on this correlation, which actually, and now it's below zero. This mark is zero here. That's actually really good thing for Bitcoin and the crypto block models going forward. If it can maintain this lower correlation, the diversification benefits of Bitcoin really work when it has this low correlation, because if it's moving in the same direction as the broad stock market, it really won't provide those benefits. But with this trend we're seeing of that decoupling of returns happening between Bitcoin and the S&P 500, we're pretty optimistic about this as a diversifying asset class moving forward.
And the practical aspect of that is we're seeing institutional investors coming into the Bitcoin market more and more. They're looking, more and more as Bitcoin being an asset class that adds low correlation to diversification to their portfolios, as well as return. So from a practical standpoint, the institutions find this to be a very positive thing.
Yes, absolutely. That's a good point, Vern. Thank you very much. And so speaking of diversifying asset classes, the other change we want to point out from last quarter that we made in our models was in our iSectors precious metals allocation. What we did in this model last quarter was sell some of our palladium bullion ETF exposure, and we bought some platinum bullion ETF exposure. Now, this model previously had an equal weight between platinum and palladium, as they've kind of been thought of as sister metals, right, as sort of substitutes for each other. And while palladium, as you can see in the chart, actually had much better returns than platinum over the last 10 years, we were still able to see, we were able to experience some of that upside of palladium having it equal weighted like that. But now, as we've been analyzing things going forward, and in our recent research over the last quarter or two, we've been looking at things, and platinum on a relative basis is quite undervalued compared to palladium. And it's evident in the 10-year chart here. And being that these metals are substitutes for each other, that's going to lead to an increase in demand in platinum going forward, most likely. And so we're hoping to capitalize on that increase in demand and sort of take some profits of the big run up palladium had over the last 10 years and overweight platinum versus palladium going forward, at least for the next year. And as we believe platinum really is the better metal of the two. And you can see the new target weight that was just instituted at the end of June. We made these trades where we have 50% gold, 30% silver, about 12.5% platinum, and 7.5% palladium. So with that change was the last thing that we really wanted to talk about here.
John, could I mention one more thing? Maybe
yes.
Go back to slide 6.
Yes, absolutely.
I think it's good to point out here our domestic fixed as just a interesting asset class. Right now, the yield on that portfolio is 5.5, little over 5.5% net, and net of all fees. And that's on a short-term bond portfolio. It's a laddered bond portfolio, and its duration is less than 2. It's investment grade quality, and you're getting a 5.5% return on it, while inflation, if you recall, as we saw above, is running at about 4%. I think it's been 40 years since we could say that a short-term high quality laddered bond portfolio could give you a better return than inflation. So to some investors, some advisors, this might be a very attractive alternative for their clients for the, that fixed income allocation maybe in their portfolios. So I just wanted to mention that, John. Thank you.
Yeah, sure. That's a good point. Yeah, I'm glad we didn't forget that. I'm going to show the disclosure page one more time. You can pause it if you need to read any of the fine print here. But then I'll end with showing the contact information for myself and our Director of Business Development, Scott Jones. You can reach us via email or phone that we have on here. We also have a booking tool available on our website, iSectors.com, where you can schedule an appointment with Scott to talk via Zoom or on the phone. Or if you want to set something up with Vern, you could reach out to us as well, and we could try to set that up too, to talk more in depth about anything that we mentioned during the presentation today. And so, if there's nothing else to be said, I don't think there is. For Vern, I'm John. We want to thank you for watching, and we hope everybody has a great day.